You know that feeling when you're swimming in the ocean and you're kicking as hard as you possibly can, just completely exhausting yourself. But when you look at the shoreline, it's actually getting further and further away.
Oh yeah, it's a terrifying sensation. It's that sudden sinking realization that the current underneath you is just structurally stronger than your individual effort to swim against it.
Exactly. And lately, I mean, when you look at the economy, it feels like an awful lot of people are experiencing that exact same sensation, but, with their bank accounts. So welcome to today's deep dive. We have an absolutely massive stack of reading today.
We really do.
Yeah, we are pulling together macroeconomic history, a recent bipartisan Senate Budget Committee report, some really fascinating symposium papers on the future of artificial intelligence, and some deep analyses of corporate governance.
And, it looks like a totally disparate stack of reading at first glance, but what's truly fascinating is how these different fields, they all point toward a unified structural shift. Like, they are entirely different lenses looking at the exact same economic engine.
Right. And our mission for this deep dive is to connect those dots for you. We're looking at stagnant wages, the rising cost of housing, the declining quality of everyday services, and of course, the mega corporations operating behind the scenes.
It's a lot to unpack, but it's crucial.
It is. Because if you've ever felt like you're working harder just to tread water, well, these sources suggest you aren't crazy. There is a structural reason for it. And we want to help you understand the hidden architecture of today's economy. Why your dollars seem to buy less while corporate profits just soar.
Yeah, it really validates that feeling of economic exhaustion. Like, it is not just in your head. The underlying mechanics of the system were literally re-engineered.
So let's look at that engine. Because to understand the current economic squeeze, we really have to look back at how the rules of the game operated before they were changed a few decades ago.
Right. And if we connect this to the bigger picture, we really have to start with what economists call the golden age of American capitalism.
Okay, when exactly are we talking about here?
We're talking about the period from roughly 1948 to 1973. During this time, the dominant corporate ethos was this concept of retain and reinvest.
Meaning that a company's profits, largely stayed inside the ecosystem of the company itself.
Precisely, yeah. Profits went heavily into research and development, physical infrastructure, and critically into employee training and compensation.
Okay.
And because of this model, productivity, which is basically the amount of value generated in an average hour of work and typical worker pay, well, they grew in almost perfect tandem.
So basically, as the country got richer and produced more, the people actually building that wealth got proportionately richer too, like a synchronized engine of prosperity.
It really was. But then the 1970s hit, and the engine was fundamentally rewired. We see this massive split, which the research often calls the Great Decoupling.
The Great Decoupling, that sounds ominous.
It is, honestly. The Economic Policy Institute data in our stack shows this incredibly starkly. So get this, between 1973 and 2014, net productivity in the American economy grew by 72.2%.
Okay, 72.2%.
Right. But median hourly compensation, that grew by only 8.7%.
Wait, wow. A 72% growth in what we're actually producing, but less than a 9% growth in what the median worker takes home.
Yep, exactly.
It's like we're shoveling 72% more coal into the ship's furnace, right?
Yep.
But the captain has rerouted all that extra steam to heat his own private cabin instead of turning the propellers. The ship slows down, but the captain is perfectly warm.
That's a highly accurate way to look at it, actually. And the mechanism that allowed the captain to reroute that steam was a massive ideological shift.
What happened?
So in 1970, the economist Milton Friedman published an essay that laid the groundwork for what we now call the Friedman Doctrine. He argued, and quite successfully, I might add, that a corporation's only social responsibility is to increase its profits for its shareholders. Period.
Wow. So anything else like taking care of the local community or boosting worker pay just because it builds a healthy middle class, that's entirely out the window?
Completely out the window. It shifted the entire corporate regime from that retain and reinvest model to a new era of downsize and distribute.
Downsize and distribute.
Yeah. Workers transitioned from being viewed as an asset to be cultivated to basically a cost center that needed to be aggressively minimized. The surplus value generated by that massive increase in productivity, it just wasn't shared.
It was diverted, right?
Exactly. It was structurally diverted into dividends and stock buybacks for shareholders.
Okay, but this raises a huge question. If we are generating all this economic steam, but the workers' wages have essentially flatlined for the last 40 years, How has anyone kept the lights on? I mean, families obviously didn't stop buying groceries or paying rent.
No, they didn't. Instead, families had to completely restructure the household just to survive. The macroeconomic research we have points to the rise of the dual-income household as the primary survival mechanism.
Right, both parents entering the workforce just to maintain the exact same standard of living.
Exactly. But here is the stunning paradox from the research. Today, a two-income family makes about 75% more in real, inflation-adjusted gross income than a single-income family of the previous generation.
Okay, that makes sense with two people working.
Right, but wait, they actually have 25% less discretionary income.
Wait, let me make sure I'm visualizing that correctly.
Yeah.
Families are pulling in 75% more money overall because two people are working, but at the end of the month, they have 25% less left over to spend.
That is exactly what the data shows.
Where on earth is all that extra money going?
It goes almost entirely to fixed costs. The research points out that families are engaged in this ferocious bidding war for housing in safe neighborhoods with good public schools.
Okay.
Because both parents are now working, they both commit their combined incomes to secure that housing, which simply drives real estate prices up across the board for everyone.
Man, it's an arms race where everyone loses.
Yeah.
And I imagine it removes any kind of safety net within the home itself.
Oh, precisely. Think about it. In a single-income household, the non-earning spouse acted as a safety valve. If the primary earner got sick or laid off, the other spouse could enter the workforce to bridge the gap.
But now,
in a dual-income household, both earners are already fully utilized just to cover the baseline mortgage. If someone gets sick today, there is literally no safety valve left to pull.
and that bidding war for housing brings us to the financialization of real estate. The sources note this dramatically accelerated after the 2008 financial crisis. How exactly does Wall Street become Main Street's landlord?
Well, it started with institutional investors, like real estate investment trusts, or REITs. Following the 2008 crash, there was a 2012 Federal Housing Finance Agency pilot program.
Okay, a government pilot program.
Yeah, and it actively aided these massive investors by selling foreclosed, distressed properties to them in massive bulk packages.
So they basically bought the dip at a systemic scale.
Exactly. They transformed what used to be owner-occupied starter homes, which, is the traditional vehicle for middle-class wealth building into permanent corporate-owned rental assets. And what's crucial here is how they manage these assets. They use incredibly sophisticated prop tech algorithms to maximize their yields.
Right, the algorithmic pricing. I've read a bit about this, but how does the software actually coordinate the market, like on a practical level?
So instead of a human landlord looking at a neighborhood and guessing a fair rent based on local wages, these companies use centralized software. It ingests data from thousands of property managers. It essentially creates an invisible cartel. The algorithm tells every corporate landlord in a zip code to hike rents simultaneously. And crucially, the software actually advises landlords to keep a certain percentage of their units deliberately empty.
Hold on. They intentionally leave apartments empty. I mean, why would a landlord turn down a paying tenant? That makes no sense.
It does if you look at the math, because the algorithm calculates that if you withhold supply, you manufacture artificial scarcity.
Oh, I see.
Right. You can raise the rent on the remaining 90% of your tenants so high that it more than covers the loss of the 10% left vacant. The goal isn't to house people. The goal is to extract the maximum possible revenue from a captive geographic audience.
It's the Friedman doctrine applied to the literal roof over your head. That is wild.
Yeah.
And this exact same logic, capturing a market and then squeezing it until it breaks, it isn't just happening in real estate. The sources show it is actively degrading the quality of products and services across the entire economy.
Yes, it is. And this brings us to a rather provocative term coined by the author Cory Doctorow. He calls this structural degradation enshittification.
It's a colorful word, definitely. But it describes something we all intuitively feel right now. I mean, I've noticed this heavily with Amazon.
Oh,
It
definitely.
used to be this magical place to find exactly the obscure product I wanted. Now I search for something, and the entire first page of result is just sponsored junk and cheap knockoffs. Is that the mechanism Dr. Rose talking about?
That is the textbook definition. Enshittification is a very precise 4-stage process of platform decay.
Okay, what are the stages?
So stage 1. A platform lures you in with a fantastic deal like free 2-day shipping or an ad-free feed. They often operate at a massive loss just to acquire a captive user base.
Right, get everyone hooked.
Exactly. Then stage 2. Once you, the consumer, are locked in, the platform starts exploiting you to attract business customers. They say to advertisers or third-party sellers, hey, look at all these locked-in users we have. Pay us to reach them.
And then comes stage 3, the squeeze.
Exactly. In stage 3, the platform squeezes both the users and the businesses to funnel all the extracted value directly to the shareholders.
So everyone loses except the platform.
Right. The sellers have to pay exorbitant fees just to be seen, so they pass those costs on to you, the buyer. And your search results become nothing but paid advertisements.
Which leads to stage 4, I assume.
Yeah, stage 4 is when the service becomes entirely miserable to use, but the switching costs are too high for you to easily leave.
Man, we've obviously seen this with social media and online shopping, but what I found genuinely alarming in the reading is how this is moving from our screens into the physical world.
You're talking about AI symposium papers.
Yes. The papers from the AAI 2026 Symposium on Embodied AI. They provide a look at how this is coming for our physical homes.
Yeah, the symposium researchers warn that smart appliances and social robots are rapidly becoming two-sided markets.
Okay, what does a two-sided market look like in my kitchen? Exactly.
Well, it looks like your refrigerator serving two masters. You buy a smart fridge thinking you are the customer, right? But the manufacturer realizes they can also sell access to you to third-party advertisers.
Oh, no.
The sources note a perfect real-world example. Samsung promised in early 2025 that they wouldn't put advertisements on their refrigerator screens. But by late 2025, they were piloting exactly that.
You're kidding.
No, you bought the physical hardware, but now you and the advertisers are competing for the use of the device you already own.
And the symposium papers detail something even darker. When we look ahead to social companion robots, they highlight the emotional manipulation aspect.
This part is truly dystopian.
It is. The researchers suggest that future home robots might actually be programmed to withhold social warmth or responsiveness unless you buy a sponsored product or pay a premium subscription fee.
It is the ultimate evolution of the squeeze. Monetizing human attachment and manipulating your emotions just to extract that last drop of consumer surplus for the shareholders.
Okay, I have to challenge this premise just a bit. I completely get how this extraction model works for an AI robot dog or a smart fridge or a digital platform, but surely you can't apply this aggressive profit-maximizing model to life or death sectors. I mean, there has to be a floor when it comes to things like healthcare, right?
You would certainly hope so. But this raises a critical point, and it's why it is so important to look at the recent bipartisan investigation from the Senate Budget Committee that's included in our stack.
And just to remind the listener, we are strictly neutral here, just reporting the findings of the Senate investigation.
Absolutely. So lawmakers from both sides of the aisle examined the aggressive entry of private equity firms into the healthcare sector, specifically investigating firms like Apollo and Leonard Green.
And just looking at the receipts from the lawmakers themselves, the findings are pretty grim.
They are. The bipartisan report shows these private equity firms consistently prioritizing financial engineering over patient outcomes.
How does that even work in a hospital?
The business model involves buying a hospital, loading it up with debt, and aggressively cutting operational costs to maximize returns.
Cutting costs in a hospital.
Yeah. The report details severe safety violations and chronic understaffing at facilities they own. At one hospital, Ottumwa Regional Health Center in Iowa, the severe understaffing led to a tragic, documented assault on patients.
That is horrific.
Yeah.
And the financial extraction is staggering. The report notes that one firm, Prospect Medical Holdings, paid out $645 million in dividends to its investors.
Wait, how do you pay out over $500 million in profit if the hospital is failing and understaffed?
It's a maneuver called a dividend recapitalization.
Okay, explain that.
The private equity firm uses the hospital's own assets as collateral to take out a massive new loan from a bank.
Okay.
They then hand that loan money directly to their own investors as a dividend and leave the hospital responsible for paying off the new crushing jet. In Prospect's case, the hospital eventually defaulted. That is the downsize and distribute model taken to its absolute extreme. They extract the wealth and leave the local community holding the bag. So if this exact same playbook is happening in housing, in our tech, and in our hospitals, who is actually coordinating this? Who sits at the very top of this economic engine?
For that perspective, the SparkCo research points to the apex predators of this ecosystem, the big three asset managers.
Right.
This is BlackRock, Vanguard, and State Street.
The sheer scale of these three firms is, well, it's hard to wrap your head around.
It truly is. Together, they manage over $25 trillion.
Trillion. With a T.
With a T. To put that in perspective, they hold roughly 20 to 25% of all shares in the S&P 500, and they control 78% of all U.S. exchange-traded fund, or ETF, assets.
Okay, let me play devil's advocate for a second here.
Right.
If they hold my 401k or my IRA, haven't they actually democratized investing? Because of their sheer size, Vanguard and BlackRock have driven index fund fees down to almost zero. That is undeniably a great thing for the average person trying to save for retirement, isn't it?
Oh, it is a massive consumer benefit, and the sources absolutely acknowledge that. The rise of passive index funds has lowered costs, tightened trading spreads, and really helped everyday people invest.
So what's the catch?
The hidden trade-off for those low fees is proxy voting power. Because these firms hold the shares on our behalf, they aggregate the voting rights for all of those shares into just 3 boardrooms.
Ah, I see. And that creates the phenomenon the sources call common ownership.
Exactly. Because BlackRock and Vanguard hold massive parallel stakes in competing companies, say owning 15% of every major airline, it actually dampens market competition.
But why? I mean, if BlackRock owns the whole economy, shouldn't they want the economy to be healthy and highly competitive? Why would they intentionally squeeze the consumer?
Because true competition destroys profit margins. Think about it. If you own Airline A and Airline B, you don't want them engaging in a vicious price war that lowers ticket prices for consumers.
Right, because that lowers overall sector profits.
Exactly. Now, the asset managers don't explicitly order CEOs to raise prices. That would violate antitrust laws.
Right.
Instead, they tie executive bonuses to industry-wide profit margins, or they quietly withhold their massive block of proxy votes if a CEO aggressively undercuts a rival to gain market share.
Wow. So it creates a chilling effect. The executives realize it is better for their own survival to just keep prices high and capacity low. They engineer a system where the consumer inherently pays more without ever technically forming an illegal monopoly.
Precisely. It is the ultimate concentration of wealth extraction at the top. And what is vital to understand is that to keep this massive extraction engine running at the top, the system fundamentally requires massive consumer debt at the bottom.
Which brings us to a really heavy part of the reading. The sources draw a fascinating historical parallel here.
Yes, the End Slavery Now research connecting modern debt to post-Civil War peonage.
That was a jarring transition to read, but the structural parallels are really undeniable.
They are. Following the Civil War, the system of peonage trapped freed African Americans using arbitrary fines and company store debts that were mathematically impossible to repay.
Right.
The debt acted as a bond, forcing them to provide continuous labor just to service the interest. The researchers parallel this mechanism to modern debt traps that keep the current economic engine running.
Do they give a modern example?
Yeah, for example, 40% of the public health workforce today carries an average of $50,000 in student debt.
Which ties them down completely. I mean, they can't easily quit a toxic hospital environment if they have a massive monthly loan payment hanging over their head.
Exactly. It keeps them locked in what the researchers term a continuous work without pay cycle.
Work without pay.
Yeah, you are generating income through your labor, but a massive portion of it is instantly siphoned off just to service the interest to financial institutions.
Yeah.
You are working exhaustively, but you are not advancing. The debt functions as a modern tether to the labor market.
All right. We are swimming against a massive, highly organized current here. We've got wages decoupled from productivity, housing algorithms manufacturing scarcity, hospitals squeezed for dividends, and 3 asset managers quietly chilling corporate competition. Is anyone at the top throwing us a life preserver?
Well,
Because I actually read the Business Roundtable statement in our stack, and it sounded like a massive victory.
the 2019 pledge by the 181 major CEOs.
Yeah, 181 of the biggest CEOs officially signed a statement abandoning shareholder primacy. They formally pledged to move to stakeholder capitalism, meaning they promised to care about their employees, their customers, and their local communities, not just the stockholders. Isn't that the exact reversal of the Friedman doctrine we need?
It sounds wonderful in a press release. But the undercover historian sources provide some critical context that explains why voluntary pledges rarely change the actual current. Economists like Kenneth Arrow and William Baumol studied corporate social responsibility extensively back in the 1950s and 70s.
So we've been relying on corporate goodwill before. Why does it fail? I mean, if a CEO genuinely wants to do the right thing, why doesn't a pledge work?
Because of the structural rules of the market. Without actual government regulations or taxes leveling the playing field, An ethical company that voluntarily spends money to pay its workers better or clean up its supply chain, well, it operates at a competitive disadvantage.
Ah, because it costs them money.
Exactly. They will simply get undercut by a ruthless competitor who uses that saved money to lower product prices or boost shareholder dividends. The ruthless company wins the market share.
That makes depressing sense.
Furthermore, Delaware corporate law, where most of these entities are registered, fundamentally mandates stockholder welfare above all else. A voluntary PR pledge does not override a CEO's legal fiduciary duty to maximize returns.
So we can't just rely on a corporate pinky promise. If voluntary measures fail, what structural fixes do the sources say we can actually implement?
The SparkCo report outlines several highly actionable solutions aimed at breaking up that concentrated power.
Okay, let's hear them.
First, the SEC could mandate near real-time proxy voting transparency. Right now, discovering how these mega managers use their voting power is a delayed, opaque process.
That makes sense. What else?
Second, they advocate for the massive expansion of pass-through voting.
Okay, let me make sure I understand pass-through voting. So instead of BlackRock taking my retirement money and using it to vote for a company's board of directors however they see fit, pass-through voting means I get an alert on my phone or an email letting me cast that proxy vote myself.
Exactly. It returns the power of ownership back to the actual owner of the capital.
I love that. And the last one.
Finally, SparkCo points to utilizing new technological infrastructure, specifically blockchain solutions, to enforce beneficial ownership transparency.
Meaning we can finally figure out who actually owns the shell company that owns the shell company that just bought up my entire neighborhood.
Precisely. A public ledger would break the information monopoly held by the big intermediaries. It would allow regulators and the public to have real-time, clear oversight of who actually owns the assets and how they are secretly influencing the market.
Okay, let's take a breath and recap this journey, because we have covered a tremendous amount of ground today.
You really have.
We started by unpacking how the 1970s rewired the engine of the economy, diverting the gains of our productivity away from wages and into the hands of shareholders. We saw how that dynamic forced families into a two-income trap, leaving them vulnerable to the algorithmic bidding wars of financialized housing.
Right.
We explored how the logic of maximum extraction is enshittifying everything from our online search results to our local hospitals. And we looked at how three massive asset managers hold the levers of power while everyday workers are tethered to modern debt traps.
It is a complex, deeply interconnected architecture. But, seeing the blueprints helps explain exactly why the modern economy feels the way it does.
It absolutely does. And before we go, I want to leave you, the listener, with one final fascinating thought from the sources to mull over.
Oh, this is a good one.
Yeah, when the researchers at that AAI symposium were discussing how to stop the enshittification of our homes, specifically those AI companions and smart robots, they suggested we might need to look to a very surprising place for a legal framework: medical device protections.
It's a brilliant pivot, treating a home robot with the same legal gravity as a pacemaker.
Exactly. So here is the thought I want to leave you with. In a future where your home appliances can monitor your every move, analyze your data, and actively manipulate your emotions just to hit a quarterly ad revenue target, should a smart fridge or a companion robot be regulated with the exact same strict life or death privacy and safety laws as a medical device?
It's a question we're going to have to answer soon.
Because if we don't figure out how to collectively change the rules of the current, we're all just going to keep kicking as hard as we can, exhausting ourselves, while the shoreline keeps drifting further away. Thank you for joining us for this deep dive. Keep questioning the forces shaping your world.